So I've been looking into the liquidity pool space, and I wanted to make a presentation about how they work, why you'd want to use them, and why you'd want to avoid them. They're kind of common now, especially in the crypto space, but there's not a lot of honesty about what the risks are and what assumptions you're making by putting your money into a liquidity pool. People think of it as a way of making your money work for you, like putting it into a savings account, but that's simply just not the case. Okay, so a liquidity pool, or automated market maker, is a structure set up by some decentralized exchanges or token swappers to expand the liquidity that they can give their users who want to exchange one asset for another. Let's give an example. You start by splitting your money into 50% USDC and 50% ETH. When a user comes along and wants to buy some ETH, they put in USDC at the current price plus the fee percent. The pool then gives ETH to the user and the current price is increased. The volume and the price are set so that after the sale, the pool is now rebalanced to the new increased ETH price. The pool operator or exchange gets some portion of the fee and the rest goes towards the total value of the pool, which is split among the liquidity providers. If the underlying asset has staking, the pool operator adds that in and then publishes an APR. This is often marketed to investors as a way of earning some interest on their holdings. Can you make money this way? Of course, there's an APR in everything. Sometimes the numbers can look a bit sketchy, but other times they look legit. But we'll go into detail about that later. The key aspect here is that volatility is earning you money. The buy price is slightly higher than the sell price. So if one user comes in and buys and then another sells, then the pool is sold ETH at a higher price and then bought back that same amount of ETH at a lower price. It's not a lot, but it adds up as more volume is traded through the pool. You then add in some staking into the mix because your underlying asset has it, and then you get some extra returns. Now, can you lose money this way? Again, of course. Unsurprisingly, this is not explained as much. Large changes in price will lose you money compared to just holding on to these assets. If you start with 50% USDC and 50% ETH and the price takes a nosedive, then the pool would have been buying ETH as the price was dropping, in effect, buying the asset while it was high. The same happens on the other side. If the price of ETH goes to the moon, then the pool would have been selling ETH as the price was climbing. If there's enough volatility or if the price returns to the starting point, then the pool will eke out a positive return. But if the rate of return based on just the exchange fee itself is low, which is usually the case, then the price change doesn't have to be that high in order to lose out compared to just holding. If you include staking to the mix, then higher yield staking rates should be expected to cause decreases in price because of increasing supply. Also, the pool operator usually takes a piece of that exchange fee no matter what happens. I'd just like to point that out. Can you lose everything this way? Well, yes, especially in pools that are offering swaps between multiple assets. Let's suppose you're in a pool that's diversified. You have some strong crypto assets like Bitcoin and Ethereum in there, some stable coins like USDC, and some high return / high risk tokens as well. For the sake of argument, let's call one of those coins Loon. As stated before, if the price of Loon goes down, then some of the other tokens will be sold to buy up the now lower priced Loon, so as to keep the balance of assets in check. If the price of Loon decreases again, more of the other assets will be sold in order to buy more Loon. If the price of Loon goes to zero, the entire pool's value will be completely wiped out. Multi-asset pools are often described as being like a portfolio or like an index of assets, but diversifying a portfolio or index is supposed to limit your risk exposure, not increase it. Okay, so let's understand what's going on here. This is not an arbitrage strategy, so in order for this to make money, it has to be making an assumption on the underlying market price and how it will change over time. In this case, it's assuming that the market price will be volatile, but mostly stable. If there's a price return, so that's a buy then a sell, or then a sell then a buy, then you earn a little bit of money. But if the price diverges, you're better off just holding your assets steady and not doing any trades. Sometimes you hear this called impermanent loss. I call it just betting wrong. If your investment strategy is short-term in nature, then using a liquidity pool can make sense. For example, if there's an earnings report coming up, then you can bet on the stability of that price leading up to that report and then pull out. After the report, you can then readjust your strategy. Likewise, if big price changes usually happen during a specific time of day, you can have the rebalancing turn off during that time and then turning on again during off hours. Likewise, if two assets are highly correlated, then it might make sense to do this in the longer term. Though highly correlated assets should be expected to have less volatility, so the return shouldn't be as good, since it's a safer bet. Just keep in mind that safer does not mean guaranteed. If, however, the two assets in the pool are not correlated, then investing long-term may not be such a great idea. Now that you're a bit deflated on this idea of liquidity pools rebalancing themselves, I want to say it's not a fundamentally bad idea. If you have a portfolio, your portfolio manager will occasionally suggest to rebalance your assets depending on the situation. A liquidity pool and a portfolio are actually the same thing. The difference is that a portfolio is focused on the longer term and does analysis every few months to see if rebalancing makes sense given what's happening in the market. Since I'm talking about a generalization of a portfolio and a liquidity pool, I'm going to call this new object just a rebalancer. So what should this rebalancer be doing? Firstly, liquidity pools make money from volatility, so the scale of market volatility you're interested in looking at should be taken into account. Liquidity pools are focused on the minute-to-minute volatility, while portfolios are more interested in the month-to-month, so we should be able to adjust between those. Secondly, the risk of a balance-out event should be factored in to protect users' funds. Next, strong changes in price can affect your performance, so we should have a means to accommodate for this and hedge the risk. Finally, operator/management fees should be as low as possible, and if anyone is stating an APR, the underlying assumptions for that APR should be clear and honest. For lack of a better term, I'll call this an OPEX rebalancer or open exchange rebalancer. This is a smart contract I'm working on that users can deploy themselves and tweak to match their long-term or short-term goals. Let's say the user creates a portfolio with 50% USDC and 50% ETH. Instead of setting a swap fee, they set a percent threshold and create two offers, one for selling ETH at the starting price plus the threshold percent, and another to buy at the price minus the threshold percent. The maximum volumes for each of these offers are set such that the portfolio will be rebalanced once one of the offers are taken up. Third parties can then watch these contracts and arbitrage between them and other exchanges. When there's an opportunity, the fastest trader gets to accept the offer. So how is this different from a liquidity pool? Well, a swap fee just doesn't make any sense here. If you charge a swap fee, then the trader that comes along to fill the order will just wait until the market price is equal to your price plus the swap fee. In effect, you would just be charging the fee to yourself. The threshold variable also allows you to adjust the trades based on the volatility of the pair. For example, if the price jumps by plus 3%, a 1% threshold will be triggered 3 times at an average price of plus 2%, while a 3% threshold would have been triggered once at a price of plus 3%, all for the same volume. The best thresholds for a given market history is often higher than what you would expect. And you can change these variables however you like, since you're the one who owns the contract. But a threshold alone doesn't make this more like a portfolio. You need to be able to analyze the risk and adjust your plans accordingly. To do this, you can set cutoff variables to limit or stop the rebalancing when the price goes too high or too low to prevent a balance out or moon out scenario. This can be just stopping the rebalancing or gradually shifting the asset weights to offer less liquidity. The point is, if the price gets out of your specified range, your assumptions about the market have been proven wrong and you should reevaluate your strategy. When you're more certain about the trend of the market, you can go long, short, or bet on stability with the amount of risk you're willing to take. There are some other terms that come up when it comes to liquidity pools, like concentrated liquidity. This is where you increase the volume of each of your trades such that by the time the higher price point in your range is reached, you would have sold all your ETH for USD, and likewise, if the price drops to the lower point in the range, you would have converted all your USD into ETH. This increases your returns, but it also increases your impermanent loss risk. I've also read something about impermanent loss protection, or ILP, that is kind of like an insurance product that some people are selling to liquidity providers to help limit the impermanent loss they experience. I don't know that much about this, but it sounds like gambling insurance, so I'm a bit skeptical. So assets that offer staking rewards add more complexity to the system. If an asset in a rebalancer has staking, then the rebalancer should be taking advantage of it, assuming that the staked funds are not too locked up in doing so. One way to help judge staking is to compare the ratio at which new tokens are being generated to the existing total supply or to circulating supply. So if 5% more tokens are being added every year, then you compare that to the percentage for Bitcoin, which is roughly 1.4%, to get a price estimate based around the Bitcoin price. So if the Bitcoin price stays the same, you would expect the token price to change to 1.014 divided by 1.05, or 96.5% of the original price. This is a very rough model. Things get much more complicated when you're talking about pricing of assets, but it's meant to give a better APR estimate for staking assets, since the high yield should be expected to drive down the price of the asset compared to the broader crypto market. Since rebalancers assume that the price will be stable, this is counter to the nature of staking assets. This means that the higher the APR from staking, the higher the impermanent loss. So the key takeaways here. Rebalancers are a bet that the market price will generally be stable but volatile, with liquidity pools being a more short-term bet due to their smaller spreads. Because this is not arbitrage, your return is earned by being right about which way the market is moving, whether that be up, down, or stable. If you are uncertain about how the market will be trending, it's better to be decreasing your risk or taking a longer macro strategy. There's a lot of bad communication out there about automated market makers and liquidity pools. Listed APRs are mostly based on false assumptions and are treated like putting your money in a savings account that earns interest, but it's not the same thing. A great amount of detail will be given to you about how you can earn money with this, but only a few side notes will be given for how you can lose. For a given investment strategy, you need to know where the risk is and what bet is being made on the trend of the market. Unfortunately, it's not as simple as an APR, especially if the investment is fundamentally a short-term one. And the most surprising takeaway for me is that the poor performance of mutual funds when compared to index funds may come down to how often they're rebalancing their funds. They often rebalance once a quarter or when there's a certain percentage change. Doing this within an index is fine because stock prices are correlated to each other, so you expect when one goes up, the other should go up too. But when you're rebalancing between assets like stocks, bonds, and currency, it doesn't make sense in the long run. That was a lot of information, and I hope you learned something like I did when researching this. The GitHub will be updated with the smart contracts when they're done, but keep in mind that for them to work, you need to let people know that you have a contract running so that they can do the arbitrage. So community needs to be created for this, which is why I have a Discord, so stop on by for a chat. You can also try creating your own trading strategy and just plug it into an exchange yourself. I believe there's a lot of potential in the DeFi space, so recently when FTX collapsed, I was motivated to start working on this open finance tech because it just made me angry at how bad companies like FTX are screwing people over. Speaking of which, I have another idea for a presentation lined up involving SBF's possible plan to pay back to customers he ripped off. I think there's a good chance it might happen, but it would just make everyone hate him even more. Of course, this is all speculation, but there's a past event in history that could explain how he might be planning on doing this, and it should make for an interesting story. Subscribe if you want to hear it when it comes out. Anyway, I'm Barry. Good luck investing.